All right, everybody, welcome back to the Cashflow Chronicles. We are back. New year, new us, 2024. Chris, I'm down a car. How about you? It was a pretty rough day in the market, but it's expected, right? I mean,
I'm up a Porsche, actually.
well, yeah. Let me see. I'm assuming you're talking about Verizon. How did that do today?
Yeah,
I don't even know.
yeah. That did very well today. It was up 3% today.
Three
So
percent. Okay.
three
Oh, almost at 40. Yeah, hell yeah. You did well.
Verizon, I told you all the 5G stocks, they did well today. Verizon did well, American Tower was up, Crown Castle was up, SBAC was up. So yeah, I mean I've done well. Atcore was up, Wire was up. So I think a lot of people are starting to realize that there is a lot of opportunity in 5G, and it's only going to be getting better the next couple of years. And so I think a lot of that value is going to start to show up. So a
Yeah, you're
lot of
right. I was just
dividend.
I was just checking our YouTube move up portfolio. I was expecting it to be down, but we're up 1/3%. So
That's right. Let's
yeah,
bring it up. Let's take a look what it looks like.
yeah. Let me take a little snippet snap. But we added so it's the first of the month. So I did check out how much we did in the December timeframe. We actually made
Mhm.
about 300 bones. So all that is getting put into this
Yep.
portfolio. So we're sitting on a decent amount of cash at the moment. Let me just hide this.
Celsius was another good one, man. I mean, if you want, we could probably buy some more Celsius. It's still undervalued compared to where it could possibly go to. So I wouldn't
I think
mind
so.
adding some more Celsius.
I think
I
so.
think
Yeah, let me pull
I
this
think
bad boy
Celsius
up.
is worth putting into. So we actually on the Patreon group we did well on Celsius. We talked about it on the Discord. I didn't put any data on like the main thing. I haven't been posting much. I need to start doing that a little bit, but we did well. Like, so you can see here, Extreme Networks was up a little bit today. So a lot of the 5G names, they did well. So that was good to see.
Yeah, Extreme was up. Yeah, Celsius up 8%. You
Yep.
weren't lying, guy.
Yep. Yep. Yep.
Okay, shit. Yeah, we
Yeah.
got $352 of cash that we can use at our disposal. So I
Mm-hmm.
know we talked a little bit last week adding Google, Verizon. Sorry, not Google, Verizon, Google, Amazon. But
Mm-hmm.
yeah, I'm just trying to think what other
I
opportunities.
say we wait on Google, Amazon a little bit, maybe this
I think
month.
so. I think there's more downside here potentially
Yeah. I
before.
think it's a good time to add our dividend players. I think this year might be a really good year. So, we'll talk a little bit offline and get some thoughts with each other,
Yeah,
to see where we can go with this. But, you know, I think this is the one thing I love about this portfolio. It's even on down days where you have like almost a 2 to 3% move down in the markets, you can see that we have some resilience in it, right? So we didn't crash as much as everyone else did. Like I know people's portfolios right now, they just took a beating today because they're loaded up with mega cap 7 or they're
hmm
loaded up with a lot of spec names. And so as they got hit, they took a really big down. So even if we're not up a lot today, especially on a down day, we still up, which is good. And then January, where I'm sure the Crown Castle paid the dividend, right? If you look at your dividends, Crown Castle probably paid out a dividend. I think the Tel Z one, there's a dividend coming at the end of this month.
I know
Um,
some of them I checked. We were a little bit late, so let me just double check who paid
yeah,
us. So we did get. Oh, that's all my portfolio here. YouTube Moolah. So we got yeah, Crown Castle $1.57, which I reinvested back into NEXT. So that's why you see
yep,
some action there.
good.
And before the end of the month ended, we got some TQQQ, which pays a very small dividend. So we got 22 cents from them. We held IWR over the ex dividend date, so we got 17 cents from them. We sold Nintendo. But yeah, I think the one that we missed by a couple days was, I think, let me double check. I know I'm not
BPYM,
sure.
BPYPM. That's the one we missed by literally, I think, a week. Had
Yeah,
we got in just a bit sooner, we would have got a nice dividend payment from that
I
too.
think
I
you're
mean,
right.
so a lot of this stuff is good. So a lot of people are going to be yield chasing, and the dividends will help kind of balance out, I think, us for the rest of the year. So I think what it is we'll get some capital appreciation. Like this is a very unique time where we'll get capital appreciation and we'll get our dividend payments, because a lot of these companies are pretty good with that, you know.
Yeah, tell
And
Z
then
next week. We literally
yeah,
have one on the 11th, so that should be like a 51-cent payout, and we have, what is that, 13 shares, so we should get like $7-8 from that.
yeah, yeah,
So it'll
yeah.
be good. Yeah, we'll probably
Yes.
reinvest that bad boy. Or let me ask a stupid question. Are we reinvesting all these dividends, or are we getting all the cash and then redistributing as we see fit?
You know, right now may be a good time to just hold on to cash a
Okay,
little bit,
no
you
problem.
know. There are some that we could add, but cash is not a bad thing. I mean,
Yeah.
maybe we can put it into a cash-like position. Um, so maybe like I don't know. We'll see. Let's
Yeah,
talk
we're
about it
getting
offline.
5% yield still, based
Yeah.
off of 5.01 from what
I
the money
kind of
market
want to
fund
put
said.
more into BPYPM, to be honest with you, because the dividend is, I think I think this one is the one that a lot of people might be missing. It's got a 13% yield and a probability that it goes up 100% once things really start to recover. They have a very strong sponsor. So, and right now we could average down a little bit on it too. So right now we're down about 4% on it.
Yeah.
You know, maybe that's something we could add a little bit too, you know, just make sure that we're not in any major
Yeah,
issues.
because by that point, it'll be less than 10% of the portfolio. Once this cash settles,
Yeah.
it'll be about $1,400. The position right now is only 1,200, or sorry, $120. So it'll end up being less than 10%, which I guess it already
Yeah.
says, right? It's eight and a
Yeah.
half
Yeah.
percent. So
Yeah.
it'll even out, and it'll probably be okay. So yeah, maybe one or two more shares of that. Did my
Yeah.
shit just go? No, we're good.
Yeah.
Um, Interesting. Yeah, so it was really cool to be able to add $300 this morning. It was nice to be able to kind of look at it and see, you know, the portfolio. And I went through each one of our streams, and it's actually been a pretty good cadence that everyone's continuing to persist and come back and join the streams, and we're on a steady trend line up. So that just shows that, you
Yeah.
know, people are really enjoying what they're
And we
seeing.
yeah, we really appreciate you guys joining us to do this, you know, because I think a lot of times when you don't have the viewership that follows along with it and that growth, it does get a little bit demoralizing. But you know, when
Yeah.
more people coming on, so I'll just say it once for the episode. Please like and subscribe if you can. Thank you so much. You know, we're not going to keep begging you like beggars, you know, with at the beginning of it, at the
Yeah.
end, and all that good stuff. So
That reminds
yeah,
me, I need to go into, because this actually helped. Actually, the last thing I'll say specifically about this crap is actually if you go into like who can actually participate and you make them subscriber only, it's actually worked pretty good in the past. So we'll do that. Well, what are you thinking, man? I mean, I'm with you with respect to like I anticipate that there's going to be some pullback, right? And I think that's just what most people are going to do. The Magnificent Seven will probably take a 5% breather here. I think it's just prudent to do that. It's been on such a massive run, but I mean, you're seeing things like Bitcoin up to 45,000, so the most it's been up since 2021 timeframe. Surprised that oil is persisting down, but I'm also somewhat not surprised that it's hanging
Mhm.
around the 70. I just think there's just too much oil right now. Otherwise, people wouldn't be cutting. But here we are, and I think maybe until the Strategic Petroleum Reserves that ends up being more steady of a buying process, maybe that's when it'll see a little bit more of um, a tailwind for oil. But until then, I think it's going to be pretty tough. It hasn't been too cold as of yet, so natural gas prices are okay. But big hits today, like Nvidia's down almost $20 today. Bros held up okay. Apple's back down to 185 because it was almost at the $200 range. So we are seeing a little bit of a pullback in some of the Mag 7, but overall, it's still hanging out. Still
I
hanging
think
out
part
there.
of
And it's
it,
not.
I think part of it could be just some profit taking, you know, in anticipation for tax season. Because that's what I said on the finance junkies that, you know, when you go up 60, 70% on a position, it's one of those things that you just want to sell a little bit, you
Right.
know, take the tax and realize the gains and then take the taxes, pay them, whatever the good stuff is. So maybe that's some of the reasons why we're seeing that. But then there's also another factor that there could be some rotation into more, you know, leveraged or even dividend payers because of the anticipation of rate cuts.
Yeah.
So, forward looking wise, that's why I think a lot of people might be jumping in. Because if you look at the utilities today, the utilities were rallying. You see that? Like if you go,
I did
let's,
see a little bit.
I'll bring the FinViz up. So
Okay.
usually,
But I agree with you, right? Like I was even thinking about this yesterday. Like I kind of just been in my own little zone, in my own little bubble. I didn't go home for Christmas, so I was like just hanging out. And then I was literally just like sitting and getting ready in the morning yesterday to like shower, shave, go to the bathroom, all that stuff. And well, not really shave, but trim my beard, all that stuff. And I was just like, man, like, I didn't even like think about it. I'm not really a New Year's resolution sort of person, but it's a stone that you have to cross going into 2024. And now that we're here, you start to think of all the things that are going to happen in the next 12 months. Elections, you know that there's going to be some rate cuts. How extensive they are, you don't know. And so with that, like you're saying, Chris, like you just have to have that rotation of opportunities into where you think it's going to persist. And so I think that's what you're probably seeing here. And shit, we're up. Some of these stocks are up, 50, 60% in the last 6 weeks. So
you want to see something really cool? So let's take a look at this. Remember this chart that I posted on Twitter? But I think pretty well,
yeah,
like not too long ago, but it's in November, right? Look at what happens with recession. Consumer staples. Remember these, okay? Healthcare, telecommunications, utilities, right? Who goes down? Industrials, information tech, and materials. So now, if you do the map of the hold on one second, let me stop this and share. You can see that some of those sectors started to catch bids. Not this one, sorry. Let me just do it's hard to switch between the two sometimes. So, okay, so we're back there again. Okay, healthcare, right? Utilities, telecom.
yeah.
See, so and energies was oversold, so it's going up a little bit. But
Yeah,
you can see here, you can see that there might be some rotation into recession plays basically now. Even though technically speaking, I don't think at this point it's a giant worry. The market may not be interpreting that. Like there's some really big names took a hit today, man. Like Uber's down 5%. It's crazy. I think that some of the semiconductor names that got sold off, they definitely needed to be sold off. I'll be honest. Like they just had too good
far,
yeah, they just had too good of a earnings. I mean, not too good of a too much of a run up. So a lot of people were just saying, hey, you know what? I'm up double digits. Sometimes some of these are even triple digits, and I'm gonna sell. But what's good is that I've actually outlined a list of semiconductor plays that are likely to do very well in the back half of 2024 once all this shit is finally sold off a little. Because I think semiconductors have a long way to go up. So one of the things that I wanted to do was set up a semiconductor portfolio, but do it in a way that I invest in companies that don't have cyclicality. Or at least aren't impacted as much by cyclicality that semiconductors traditionally are impacted by. Do you invest in any semiconductors at all?
I have in my traditional IRA, I have a little bit SOXL, which is triple leverage semiconductor, and that's just like
Ooh.
it's one of those yacht plays again.
Yeah.
It's like $1,000 position. It's not a lot, but back in 2020, 2021, when semis were running, and I mean running hard, I would sell very far out of the money puts on OSOXL, and that's part of the reason why I was being so successful and creating some income in 2020 and 2021. And then when it turned hard. So I stopped selling on that at that point. But do I have any others? I used to sell some puts on Intel. I never really took control. I did maybe hold some for like a week or two after a bad earnings report. But for a while, Intel was in like this channel where it was going into like the low 40s and then it was going up to the 50s, low 40s, 50s. And then obviously the last 6 months to a year, it's been a lot more abysmal than that. So I haven't been playing around with it at all. And luckily I didn't get caught with it, but it's actually up like 30-40% within the past month or two. So shout out to the people that bought Intel and maybe DCA'd when prices were down. I think it'll end up getting back on its feet. But in terms of other plays, not really for semis. Other than those times and periods of time where I mentioned, I don't really have any in the moment except for that really small position in SOXL.
The one that take a look at this one. This is called Synopsys. What they do is they are an EDA software company. So basically, what they do is they help in the design of chips, right? So if you look at literally their 5-year chart, look at this up and to the right. Very little to no cyclicality. So when you compare this to something like Nvidia, right? Even though everyone looks at Nvidia, which is the hot, sexy darling, Nvidia has cyclicality, right? So
Yeah.
if you look at Nvidia, it went from up riding really high during the crypto boom to coming down, and then now it's riding high again. Businesses like this are nice to have because you will have portion points where you're going to do really well. But I'd rather be in companies that have this, where they have just a
Do you
nice,
think that that's
yeah.
just because it's behind the scenes? Like I've noticed a lot of some of these companies that are just more deliver behind the scenes and they don't really
Mhm.
get that brand recognition or in the spotlight as much. They seem to just deliver and they don't have that sort of cyclicality like you're
Well,
kind of
that's
stating.
because the business model that they have is based more on licensing than actual product demand and ebbs and flows. So right now, if you look at, and this is the thing with like me and you will talk about it, oil and natural gas, there's cycles, where you
Yeah.
have the price when shit goes really high, the valuation of the companies that are underlying them, they go really high at the same time, but then the oil prices drop, and then all of a sudden now the price of those companies comes down. Some don't even survive,
Yeah.
and the ones that do survive end up, so there's a lot of cyclicality in that versus someone who you're just licensing software to for the next 5 years with a waterfall. And basically now you're going to see like just a smooth line up, right? And so I think we need to find these hidden gems that have the ability to command good pricing with a almost like a toll road kind of business, right? Where
Kind of like a
basically they make money.
midstream, but for electronics, I guess is what you're
Yeah.
saying.
Yeah, exactly. Exactly. Like me looking at this field, EDA providers, there's only two major ones. One of them is Cadence Systems, the other one is Synopsys. Both of them are very well run companies. They've had consistent earnings, they get cash flows which they just use to buy back shares. So it's a really great business model. So I think sometimes what we do is we take a look at a sector and we're get kind of bullish on it, but I think we also should take a really good look at the business model, right? And say, okay, how does this company perform in good times and bad times? And if they're able to perform meaningfully in good times and not so bad in bad times, that's a company that you want to hold for the next 10, 20, 15 years. Because you will see that. Like, do you know a company called Packard?
Yeah.
PA Packer, right? I had no idea about this company, but it's been a consistent, grower. Um Let me just show you
It's
guys what I was.
PACCAR, right? If I remember correctly.
PACAR. So let me just, that's the ticker symbol. So this company right here,
Yeah, yeah,
Packard,
PACCAR.
they just pretty much make trucks, right? Like, so if you look here, it's an automotive company that makes large commercial trucks. If you look at the last however many years, this is just a up and to the right company. Sure, it's got some weaknesses here and there during the great financial crisis, but for the most part, it's just up, 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 up. Kind of cool to see businesses like this. And the thing
Yeah.
is, like, they're up 145% over 5 years. Are there other companies that have grown way more, way faster? Absolutely. But if you're looking for a consistent return over a long period of time, companies like this, they keep compounding on themselves. They're very well run.
That's the
They're not,
thing though. Like I think,
yeah.
it's companies like this that sometimes can be out of favor because it's not sexy. But at the end of
Hmm.
the day, in the environment that we're in where we are in terms of technology and being able to kind of have transport goods and everything the like, it's railroads, it's large trucks. And so until you get to the place where you have these autonomous vehicles that are all run by Tesla, apparently, or autonomous trucks that are all going to be run by Tesla and can go 3,000 miles on their own, then you need something like that to be able to run the country, run the economy. Otherwise, it's going to. So many times I've invested in great companies that fall out of favor. Like Union Pacific was one that I bought back in like 2015, and over the course of like 2 to 3 years, it went from, because it just did a share split back in that time period, it went from like 90 or 95 bucks to the point where I had to split the stock again because it went up 100% within a matter of a couple of years' time. And it's companies like that I think a lot of people just don't even acknowledge because they're out of favor. They're not sexy. They're not creating the next iPhone. They're not creating the next iWatch. They're not doing VR. They're not doing AI. But in their own way that they kind of are. Like those are the kind of companies that have sufficient like delivery and have the sufficient margins where they're either buying back their own stock or they're making sure that their margins are getting squeezed out. And when you think about it, going from a 19% margin to a 20% margin is going to uplift your earnings per share by 5%. And if you do small things like that over time and buy back your stock, it's just going to be super meaningful, right? I mean, there's a reason why the Buffetts of the world and the Bill Gateses of the world buy some of these railroad companies. It's not because they're sexy. It's because there's probably lower volatility in the stock. It's a good place to park money. They get a little bit of a dividend and a drip. And at the end of the day, these are the things that are truly powering America, powering North America in the case of Bill Gates, because it's Canadian Railway. But things like that are the backbone of some of these economies that you just kind of forget about because they're not flashy, they're not sexy, they're not the headline sort of companies that everyone wants to hear and talk about. But some of those companies like Caterpillar has been one of my best investments. BHP has been one of my best investments. Like you forget about it. Like in those are the things that at the end of the day, like you find it out of favor, just even a little bit, even 20-30%. And it comes back into favor. Like it can happen within a couple months. The whole market could be sideways and you end up being up 20-30%.
When people talk about buy and hold forever stocks, these are the buy and hold forever stocks. You know what I mean? Like Caterpillar, John Deere. Think people are going to stop using tractors? People are going to stop
using. Oh my God. Don't even get me on Deere. I looked at Deere the other day and I wanted to throw up because John Deere, I'll just pull it up. I thought about buying this not too long ago, but they're doing a lot with like automation and stuff. And just over the past 5 years, they've just been on a complete tear. And it's just, it broke my heart because I remember back around the same time I was buying into Caterpillar, Deere was a little bit more expensive. And at the same time, I was like, I don't know. I know they're testing around with some of this automation and boom, here we are, 5 years later, and the stock.
Look at when this company was founded. Look at when this company was founded.
What is that?
1837. 1837. That's crazy, right? 1837.
It goes to show you, man, you can teach a dog that's part of the cool thing, right? These are the sorts of companies that when you're looking for, because we're talking about the year, the dividends, maybe plays that you specifically, but this is the problem that I've gotten into trouble in the past. And I know many others are still in this spot where the problem with dividend investing is sometimes you can see the number that you're going to get on a quarterly basis, yearly basis, whatever. And you get almost super obsessive. And it's one of those things where it's like, you need to find the appropriate balance between a company that is rewarding shareholders through dividends or share buybacks, but also making sure that they stay on the frontier of innovation and continuing to reinvest themselves back into the business. Because very quickly, within 5-10 years, if a company stays in the back of innovation, very soon the yield on that company will go from 3.5% to 4.5% to 5.5% to 6.5%, and it's become a yield trap. And the reason being is because sometimes these companies just end up getting themselves in a place where all they're focusing on is the margin, and they're not focusing on reinventing themselves and bringing themselves into the 21st century. And I see a lot of problems with that with banks. to be very honest with you. See a lot of problems with that with oil and gas companies to an extent,
Yeah.
where you start to see these companies getting to a place where they haven't changed. Like you go to a Wells Fargo welcome page and it's like, is this from 2000? Like what is going on here? Like why is this 20 years old and I'm still using this website? Like it's insanity sometimes where you see companies sit so much on their laurels. And AT&T, to an extent, when I moved back from Trinidad, was one of those, and that's actually why I sold out of AT&T back in 2020, was because when I got back from Trinidad, I had, I don't know how many shares of AT&T, but I was in it for the dividend at the time, and I bought in at a really good price because the pandemic gave me that opportunity. And as soon as I came back from Trinidad, they're like, okay, download these 3 different applications. One is going to be for your TV, one's going to be for your internet, and one's going to be for, and I'm just like, what the absolute hell are you talking about? Why am I not just using one application? Like, why do I have to download 3 separate? It's like they've bolted on so many things that they never fully integrated it. They never fully integrated DirecTV. They never fully integrated, Uverse. They never integrated all these other things. So you end up just being like this company where you have 3 or 4 different companies all, and it's like the amount of synergy and efficiency that could be had and the billions of dollars they could add to the bottom line just by focusing on innovating and making things more efficient within the organization rather than focusing too much on buybacks or dividends and stuff of the like. You get in this very circular sort of place with shareholders, whether that's BlackRock, that they just say, I just want all the dividends, and they just want you to be that company, and they'll invest in something like a SpaceX so they can be involved in Starlink and the new innovation pieces. It's kind of interesting when you think about it. It's just like when you look at who truly owns a lot of these companies, what chess pieces are they trying to use these companies as? Are they trying to be pawns? Are they trying to use them as knights? Are they trying to use them as kings, queens, rooks? Like what exactly are we on the BlackRock scale? What are these companies actually looking like? But anyway, it's a different story for a different day. That's a huge rabbit hole.
Yeah. I mean, right now, to be fair with everyone, there's just not a lot of great opportunities in this market. I mean, a lot of the things that we've identified that's in the portfolio are probably like the areas that we want to invest in. I'm sure that there are things that we're missing as well. So don't say like, "Oh my God, you think that the market is just a small
Well,
hodgepodge."
can I clarify that statement,
Yeah,
Chris?
yeah,
And
go for it.
I want you to finish. I'm not going to interrupt you
Yeah.
long. Do you mean for a quick like 2 to 3 week or a month long pop, or do you mean for like 6 to 12 month pop?
I mean, more like a 6 to 12 month, because like the valuations are high. Right now, there are a lot of great companies, but the valuations are high. And even from a sentiment standpoint,
Yeah.
I think the sentiment is high too. So which
Yeah.
means that, you typically want, what they say, you should be buying when when people are fearful. That means that you're getting the best deal possible. That's not to say that if you bought something today that you can't make money by the end of the year. It's just that the chances of you making money by the end of the year are not as good as if you just wait a little bit. I don't think that
Yeah.
there's a lot of waiting that we have to do. I think January, February might be some tough months for the market. And then we see some more, positive movements come about. But I think right now is a good time to just, once again, don't sell your positions, enjoy the positions that you have, collect your cash. And when good things start to come back, buy them up again.
Yeah.
Buy
No,
companies.
I hear that.
Yeah.
I think find the companies that you think are where you want to potentially double down on, say for the next 5-10 years, and wait for a decent, well, 5-10 years. I don't know about all that, but
Yeah.
for the next 18 to 24 months, wait for a slight pullback, keep
Yeah.
the cash on hand. Like for me, I'm not really rushing to buy anything right now. In fact, I'm
Yeah.
probably going to keep adding to my cash position a little bit because you know me, I always run really hot in the market. I don't
Mhm.
really have a lot of cash. And so for me, being able to potentially store up some cash, whether that's for a future real estate deal or if I see a good opportunity, because there are still some opportunities. Like for me, Rocket Lab, that's what at 531. If that dips back out in the
Mhm.
$4 range, like I would love to pick up some more, get another 2,000 shares out of that. Um, so there is some opportunities, but right now the whole macroeconomic environment, you know, it's all kind of toppy at the moment, right? And
Yeah.
having that opportunity for it to to swing a little bit more in my favor, especially with something like a Rocket Lab, that could see a 20% retracement, even 25% retracement in its stock price, when the rest of the market might only see a 5 or 10% pullback. And so having that choice of being able to sit and wait, especially when something isn't as, how do I say it, maybe as imminent of a as an exploder as, say, Rocket Lab, for example. There's still a lot of capital exposure risk associated with it. It's not profitable yet. There's still milestones that need to be achieved. And so, until that point where we start to get to more profitable, or a lot of those milestones have been exited off of, you have time to add to some of these positions. Like Palantir, I think, is a good example. I don't think you need to be rushing into Palantir. I don't think you need to be rushing in. Like, these things will, with a macro environment pullback and the market taking a bit of a breather, things like Palantir are already starting to retrace in their prices. You could see it get back to $12 or $13 if you see the rest of the market, deflate a little bit by 5-10%. And I don't think that's something too crazy to think about. So look for things that you want to add to. Don't rush out and buy them. But sometimes at the same time, don't pinch pennies when you're looking for dollars at the same time, right? Like, if you see a company and you're like, oh, I always wanted to buy this at below 13 and it's at 12, and you're like, well, maybe it's going to get to 11.50.
Don't get too greedy. Don't get too greedy. Yep. Yeah, I mean, don't get too greedy when things are when things go up, and don't get too greedy when things go down. Greed is controlling your greed centers is probably one of the hardest things to do. I put on the Patreon, I put a post on it. I said, Einstein says the greatest force in the world is compounding interest. And I'm like, it's probably more along the lines of coveting your neighbor's gains, because when you see everyone else making a shit ton of money, you just feel you feel like crap for not getting in on the game too,
right.
And that's what causes a lot of people to overpay for things. And it's just like, this guy made all this money, bro. I'm smarter than this guy. How come I'm not making this money? You know what? I'm gonna buy in, and then before you know it, you're kind of stuck because you overpaid for something. And now what happens is, when things go down, the best you can hope for is a break even, for the rest of the year. So it's just one of those.
I see some very wise people that I know, and let's just say they're work smart, but they're not necessarily street smart or Wall Street smart, maybe is a better term.
Mm-hmm.
And they'll be the people that, as soon as the market gets a little bit iffy, they'll sell, and then they'll or hold on too long and then wait till their position's down 20% and then sell, but they'll never buy back in, or they'll never. So they're people that just don't have the emotional fortitude, because they have yet to experience the cyclicality of a market. Even just as something as simple as going from a 10-15% run up to a slight 5-10% pullback, that sort of thing will scare them. And there's something to say about taking some profits, but don't always rush to sell everything, because a lot of times the market will turn around right on its head after being down 5-10%, and then immediately go back on another 10-15% run. And I think we're still in that sort of market. I don't think that the economy has changed in a way where we should be seeing a large pullback in the order of 20 to 25%. So just be vigilant. Like, if you see opportunities when it's pulling back 5-10%, sometimes you just got to swing.
Yeah. So right now, one of the themes that are there any themes that you're looking for 2024 that interests you as an investment thesis, to say,
themes?
You know what? Yeah. Like, do you see any sort of a sector or a disruptive technology or something that could lead to a lot of gains into 2024? Like, what do you think? Like, are there any specific events that are happening in the background? Like, I'll give you one one that I think one of the things that I've been really focusing a lot of research and due diligences on is the telecommunication sector with 5G, to see, okay, where is the major benefits for 5G? So 5G was this promising thing 5 years ago, and I think a lot of people were burned by it. but not because of anything that's wrong with the technology. It's just 5G adoption took longer compared to the other technologies that were out there, primarily because of some challenges around spectrum. What I mean by spectrum is not the cable company. The spectrum, which is what you have to license in order to project out that 5G signal. So
Right.
a lot of those issues are finally being resolved now. And I think the development of 5G and the connectivity of 5G devices are going to be a big thing for the next 5 years. And so we're very lucky that a lot of companies that are in this space are also trading at very low multiples. So I think there's a tailwind of of um, disruption that these companies are getting pushed forward with, and then at the same time their valuations are low. So I think that's like the sector that I'm focusing on. So the theme that I'm focusing on is 5G. Another one is of course the cloud. I think there's still a lot of room in
A
the
lot of
cloud,
room on there,
you
man.
know. And there's one more, which is silicon carbide. Do you know anything about silicon carbide by any chance?
Is that this is a silly answer. Is that the thing that they discovered last year that could disrupt a lot of like the no?
That's the KN
Yeah, okay, okay.
thing. So no, okay, silicon carbide is, you know what? Let's watch a quick video. I
For
think that'll
sure.
help us kind of
So
understand it.
while you're
And
pulling up
yeah.
that it's a difficult question to answer, Chris, and because
Mhm.
2023 was it's so easy. Like, you know what I mean? Like, I think a lot of people might be like, "Oh, I don't know, man. Like, it was really difficult." It wasn't, man. Like, when you have opportunities like Chris had buying Meta at what $88 or whatever, and I had opportunities buying. I bought the wrong stock though, Chris. I bought Google and Amazon instead, but
Hmm.
just because I'm more bullish on those long term than Meta, but God, it was a no brainer on some of these things, right? And getting to a place now where you've gotten to a place where things are, I don't want to say frothy to an extent of like they maybe were in 2021, you know, when obviously the reason why we had the 2022 pullback in the first place, but being a stock picker at the end of 2022, early 2023 was pretty damn easy. And to me, it's harder because I feel like 2024 is going to be a year of delivery and trying to feel it out. So I think that there's going to be ebbs and flows throughout the year, you know, and I still don't necessarily know. I still think that we're going to have a side swipe hit us in either the January FOMC or the February FOMC or the March FOMC where, you know, they're still super bullish or hawkish on what the heck is going on, and people are like, okay, well, maybe we're not getting six rate hikes, we're only going to get two or three. Sorry, cuts, six rate cuts, we're only going to get two or three, and so I think that's going to swipe some people out of nowhere. Which to me, I don't think we're going to have six cuts. I think that's way like too soft, right? I think we're still in a place where we have to feel it out, and the market's still running really well, in my opinion, from a macroeconomic perspective. That you still need to keep interest rates a little bit elevated, but not cut them by 6 times this year. So to answer your question, I think where I'm going to play is I like cloud. I think AWS and Google will continue to do well. Um, I think out of the Magnificent Seven, those are both of the ones that I would still personally add to. I would love to see Google have a pullback. I think we're going to see phenomenal results out of Google this year, just from buybacks being a
Mhm.
huge tailwind for the EPS, but also just delivery in general. And then I think AWS, I'm really curious to see how they do this quarter. And do they break 160, 165 billion in revenue for the quarter? That'll be a new high for them. Where do they where do they think revenue will get in 2024? Do they think they can get to 650 in revenue? But I think a lot of that's going to be amplified by how quickly AWS revenue is growing as well, because that's still growing at a 20 to 30% pace. Um, so Google Cloud as well at a 20% pace. Um, and that's where I think a lot of Google's revenue, or sorry, earnings gains will come from. Um, in say the next 12 to 18 months is really their Google Cloud provider. Now that that's truly hitting profitability, it's like a Palantir kind of just like coming out of nowhere, right? It's getting to a place where it's just hitting profitability. So the earnings from that specific sector is going to be huge. The growth in that specific sector is going to go from just slightly over $1 billion to 3-4 billion in pretty quick succession. And so when you add a multiple of 20x onto that, that's going to be 80-100 billion dollars of market cap added, and that's not going to stop. In the shorter term, I think it's going to persist for the next 2 to 3 years for Google. So you're talking about 100, maybe a couple $100 billion of a market cap added for their Google Cloud platform now that that's performing. So yeah, in terms of specific plays, Chris, I don't know. I still think that there's opportunities out there like small caps and medium caps that have fallen out of favor that are still profitable companies that are trading at low double digits to mid teens that need to get back closer to 20x multiples because they're just premium companies. And then there's some companies like I think it's going to be tough for a lot of people because I think a lot of these companies that did return 150, 300% last year because they had such a shitty 2022. I think a lot of those are going to give some gains back. And I think a lot of people are going to get caught in that. And just like they were also hyped up about the end of the year being up 150, 200%, I think a lot of those, and I think Palantir could be one of those ones. I think there's going to be a lot of companies that just aren't worth their weight in the market, and they'll sadly give back gains. So to me, I think it's more easy to choose which companies won't perform in 2024 than will perform.
Gotcha.
So anyway, back to your video.
Yeah. So, a lot of what's going to be talked about in this may be a little bit, may go over your head. So if you want to watch the video, we'll leave it in the comment section. So, let's take a look real quick and we can talk about it. But silicon carbide could be something that could be a growth industry for the next maybe even a couple of decades, actually. So let's take a look and then we can go from there. 1 second. And there's a few key companies that are in this specific theme that I'll go over at the end of this video.
Tipping point for the electric car market, going from a niche of only early adopters to mainstream mass transportation systems. And by 2030, all predictions points to a rise in market share from a mere 2.5% in 2019 to 30% in only 10 years. But as demand for electric cars grow, so does for batteries and more efficient power conversion systems. Lithium-ion is the obvious choice to lead the way of energy storage, but what about power conversion? Most electric cars these days use alternating current motors since they offer several advantages over DC. But batteries can only output direct current, and that presents us with a problem. How do we convert DC to AC efficiently? That is the job of the inverter. You see, electric vehicles rely heavily on inverters to work in two fronts: onboard battery charging and power control units. Although the combination of the two varies depending on the car model, silicon inverters have significant problems with power loss, or as much as 20%. This means shorter driving range and longer charging times, a problem that has plagued electric vehicles for decades. But little did we know that the answer to this problem hit Earth thousands of years ago. Hello everyone, Subject Zero here. In
It's like we're watching a
1896, a man
science.
studying rock
Yeah, I feel like we're
at
watching
a
the History
meteor
Channel.
crater located in Canyon Diablo, Arizona, made a remarkable discovery. Henry Moissan found one of the rarest minerals on the planet, known only to be found in meteorites. It was named after him as moissanite. At first, it was mistaken as diamonds, but later tests showed that the sample in question was silicon carbide. 2 years earlier, this same mineral was being artificially made by Edward G. Atchison while researching ways to make artificial diamonds by mixing clay and coke in an iron bowl with a carbon arc light. Arc lamps were a type of lamp commonly used for various purposes in the turn of the 20th century. It produces light by electric arcs, also called voltaic arc, in between two carbon electrodes. At the end of the experiment, shiny hexagonal crystals were found attached to the carbon electrodes. He called these crystals carborundum, since it was mainly made of carbon in an analogy with corundum, a crystalline form of aluminum oxide that is extremely hard and also used as abrasives. The fact that Atchison achieved mass production of silicon carbide a few years earlier than Moissan's discovery opened the speculation that his finding of the natural form of SiC was due to a contaminated sample since SiC abrasives were already in use. But later findings in other meteor sites put this question to rest. To date, SiC is one of the best and most used abrasives in the world due to its simplicity of production and hardness of 9.5 in the Mosh scale, almost pairing to that of diamonds.
So if you've ever used like sandpaper and grit, a lot of it's coated with silicon carbide. Same thing with the silicon carbide discs that they use to do like smoothing of surfaces and stuff like that. So it's like it's a very very hard substance and it's easy to produce. But there's a lot of other applications that can be used for in the future. So we'll take a look at this and finish it up.
10. As a side note, SiC wasn't just used as abrasives. Throughout its history, it was part of many important technological advances, such as the discovery of electroluminescence in 1907. Eventually, this led to the creation of the first LEDs. Then we have body armors, telescope mirrors, and electronic circuit elements, all of which share a form of silicon carbide. Now, SiC is about to take over the electronic industry, and this is what makes it so important. SiC is as important as battery technologies. It enables huge reductions in power loss. For example, in a MOSFET diode, SiC makes it easier to achieve a thinner drift layer because of its critical breaking strength that can be as much as 10 times higher than that of silicon. This results in less electrical resistance, culminating in up to 70% reduction in conduction and switching losses at high voltages. In high voltage, we are talking about as high as 2500 kilovolt per centimeter, while for silicon, you are looking at most 300 kilovolt. This is possible because of its excellent thermal conductivity that is 3.2 times higher at 4.9 watts per centimeter Kelvin against 1.5. And lastly, we have the band gap. Depending on the polytype, it can be almost 3 times higher, at 3.23 electron volts against 1.12 for silicon. This means that SiC is less likely to suffer current leakage, thus making ideal to work at high temperatures. All of this translates into better electronics with a dramatic size and weight reduction along with smaller cooling systems. Since SiC can operate at higher temperatures, the energy needed to maintain cooling can be reduced by up to 30%, if not more. This is why silicon carbide is an important component of the electrical revolution. Some estimates say that this technology could decrease up to $2,000 of the overall final price of EVs. Goldman Sachs predicts that by 2030, the SiC market will hit or surpass $5 billion. And most important of all is charging times. Current technology can reduce charging times by half with a 65% increase in power density. As a frame of reference, the Tesla Supercharger V3 has an output of 250 kilowatts at a 500 volts and 500 amps. It takes about 1 hour to fully charge the battery pack, or about 30 minutes from 0 to 80%. SiC can increase the output power by at least 2 times, where the only limiting factor would be the batteries. But in the near future, expect that to change as batteries get better. Charging times should drop to less than 30 minutes for a full charge. All of that thanks to silicon carbide, a subtle revolution in the works. All right, folks, that's it.
That's pretty interesting, and I'll let you kind of. But my initial reactions to that are specifically around, and I don't know if it'll get to this, but I anticipate it will to an extent. Something as simple as a GPU and how much fan speed you need to keep those things cool, for example.
Mhm.
So, to give people some color on what I'm trying to describe, I do hobby mining with Ethereum Classic on my laptop here, and it's a NVIDIA 3070. So it's not one of the newest ones, but it was pretty top of the line about 1 or 2 years ago. And even still, that thing runs at about 86, 87 degrees Celsius when it's mining. And when you think about that, this thing sounds like it's a jet airplane trying to take off when I'm mining because the fan speed is just going so quickly. And you think how much energy is being lost to having to heat or speed up that fan so quickly. So if you can run things cooler and not have to have as much fan, then you can go in more into directing the energy into actually doing some mining and actually increasing the hash power and calculation speed rather than focusing on having to balance the power that goes to the fan as well as the chips to help do calculations and stuff like that. That's where my initial thought process goes to is that.
So there are a couple of ways to play this. The one that I found to be the most interesting is not going to say on YouTube. You're going to have to go and join the Patreon because the Patreon gets all the value. Sorry. That's just how things roll sometimes. But yeah, silicon carbide is definitely an area that's very interesting to look at. There's a lot of great companies, especially in the semiconductor space, that are really working on creating the next gen technologies that are around it. Silicon still, like regular silicon wafers, are still the name of the game, but lo and behold, I think in the future we could see more development around technology around silicon carbide. And yeah, like I said, there's a few companies that really are doing a lot to develop the technology further and further, and it's something that I'll cover on the Patreon sometime in the next couple of months as I get all my DD done on it. The only thing I would say is semiconductors right now are, for the most part, are in terms of valuation on the high side of things. So just, not exactly the best time to be buying, but eventually.
But it's one of those things where it could be, if they incorporate it in, that their margins increase due to the fact that they're able to maybe even slightly decrease the price of their current semiconductors while the efficiency of them continues to go up. And so it could be something where it allows, if they adopt this technology, it allows the price of those things to kind of come into maturity, right? So you don't necessarily, you might not necessarily have the huge cyclicality as you might used to have, because the efficiencies of those things are going up. Anyway, that's just my immediate kind of reactions. I don't really know, nor do I have done enough due diligence, but that's just a thought process.
And there's a lot of sectors that this becomes very promising in. One of them, of course, is the EV part, EV for charging and everything else. But then there's also things around 5G and cloud power optimization. You've got energy infrastructure like solar panels and stuff. So, when we talk about Enphase and these micro inverters, people don't necessarily talk about, like, okay, so what's in these inverters that make it a value proposition? Like, what gives them the ability to change from AC to DC and do it in a way that, and do it in a very power efficient way? Because remember, anytime you gain efficiency, you're reducing cost, so these are the things that, I always tend to try to take a look at rather than just focusing on, like the core technology itself. I'm like, okay, so what's the thing that's hidden behind this core technology that's going to make this a giant business going in the future? And I wish I had done more research into this, because the company that I'm looking at right now is up significantly since the technology really started to come on the forefront. But by no means is this the end. I think this is only the beginning, and it's something that could end up being like a nice 10-year hold. So so we'll talk about it eventually on here, but all the DD is pretty much going to be subjected to the Patreon for now. So join if you want. And guess what? The prices of the Patreon have gone up. So now people who were on there before, congrats. You guys are in the legacy group. You don't have to pay anything extra. The new people, I'm sorry. What can I say?
And how many spots do you have open for the year at the moment?
I didn't put a cap on it,
Not yet.
but I'm gonna cap it soon because I'm just
Yeah.
like I'm getting a lot of questions. I want to help everyone like answer questions individually, and I think a lot of people have, and this is the part that I think is a little bit disappointing for me, but they will ask me about a company or a sector that I have no idea. And I don't like saying, sorry, I don't know much about it, but that's how it is. If I don't know anything about it, I'll just tell you, like, sorry. Like someone asked, I think about JetBlue on here at one point, and I was like, sorry, I'm not an airlines guy. Like I
Yeah.
know the basic concepts of airlines, and I know that there are some that have business models that can outperform others, but for the most part, I'm just not an airline guy,
Yeah.
So
No, I hear you.
yeah.
No, I mean it's there's this certain industries that I'm more privy to, right? Like I work on oil and gas, so I know a little bit more about oil and gas than maybe the average person. Am I an expert? Maybe not. I'm an expert on getting it out of the ground. Am I an expert on the stocks? Probably not. But I know a little bit more about how the industry works, the cycles that it goes through, and understanding when is probably a good time to buy and when is not a good time to buy. But there's that aspect of it. So I wouldn't expect somebody to come in and ask me about, I don't know, healthcare, and I would know. It'd be very, very much like that. So, but there were a few questions in here that I did want to answer. Somebody I think earlier asked about some of the covered call ETFs, and look, man, like it really all just depends on your portfolio. Like I say this so many times, but it's really the truth, right? I mean, are you looking to grow your capital position, or are you looking to grow your dividend income? And I don't necessarily think like it's one of those things where, to me, if you need to figure out how much money you need to really earn in retirement. Like if you're sitting there being like, I really want to earn 50 grand in retirement, then it's a very simple equation, right? It's like you could have a 10% yielding covered call ETF and have 500 grand of it, and who knows what's going to happen to your principal. But at the end of the day, you're going to get 50 grand. And of course, it's probably not going to be in terms of the, what's the word I'm looking for? The tax advantage piece that you're looking for, but you're going to get your 50 grand, right? To me, I'd rather much have something that's a portfolio that's yielding 2.5%, and have a couple $1 million worth of that and get my $50,000 that way personally. But I know that not everyone can get to that point. So you have to play a balance between the two and really understand what you're risking and where your end goal is, right? Because to me, if your goal, like I see so many people specifically chasing like dividend yield and stuff, when in reality they need to be focusing on getting their money right. And what I mean by that specifically is like focus on, and I don't want to say baby steps because that's like a Dave Ramsey term, but focus on being like one thing. Let me take a step back. If you want to be a millionaire, you have to be right in thinking like a millionaire, right? You can't, the whole market is testing you to see if you have the capability to manage more and more money. And it's going to try to test you throughout that time period to see, is this person able to handle $10,000? Are they able to handle 15, 20, 100, 150, 200? And that whole time it's a test as to whether or not you can perform at that next level. If you can't simply manage a monthly budget and save $500, $1,000, you're not going to get to $1 million, my guy. Like, because at that point, if you could barely get to a place where you're able to save $10,000, not magically is $1 million going to show up into your account. So you really need to think about, what steps and what actions you put into play, because in order for the $1 million to show up into your account, you have to think like a millionaire first. You have to act like a millionaire. So that way, by the time you actually are a millionaire, you get to keep the money. And that's not a quote that I've kind of made up. I mean, that's something that Jim Rome said, and he said it a little bit differently than I just did. But at the end of the day, you have to think like, if anytime somebody gives you $200, you go buy a $150 pair of Air Jordans, like you're not going to be able to get to the place where you can be a millionaire, right? Like you really have to think of your life as a business. If you're investing in these stocks, you're learning how to invest in these and look at the income statements and the cash flow statements. You have to put that kind of persistence and knowledge into your own life in order for your own lifestyle to look like a business, right? You want to become $1 million business, you got to be able to put the action in play to be able to do that. You can't just like wish it into existence by investing $500 in the stock market. So you really have to think, with the end in mind, where do you want to get to, and put your chips in the way that you want to play it. And if you just want to make as much dividend income as you can, shit, man, there's a way that you can do it. Is it going to be the safest? Probably not. But, you have to think about what's your capital exposure risk and what your thoughts are. And that's all I'll kind of say about that.
Yeah. All right. We're at the hour mark. So, yeah, we'll talk more about the market sometime tomorrow. I think the first month of this year is going to be very interesting. And I think that it might set the tone for the rest of the year. It's an election year. I think overall we are going to likely end in a positive light, only based on some historical stuff. But, I'm keeping my eye on this recession narrative. There's times where you can make money during a recession too. So don't think that, hey, there's no places to escape to, or there's no places that you can make money. Even if it's just capital preservation, that's a win. If the general market is down and you're down a lot less than the general market, that's a win,
Yeah.
But I'm not going for the win this year. I'm going for the good win. So I'm hoping some of the sectors that I'm looking at can outperform, and I think they will. The only thing is I'm in no rush this month to be adding to a lot of positions. Instead, focusing on quality, finding names that have consistent cash flows that are going to benefit from this rate loosening cycle, and hopefully it'll carry us into 2025 with a good amount of return, so that this way we can focus again on 2025, some new areas. So
yeah.
Yep.
You're the man, my guy. All right. Well, much appreciated as always, and look forward to talking to you tomorrow.
All right. Later, guys. Take care.
Thanks everybody for stopping by. Make sure you guys like the new channel and subscribe to the new channel as well, Cashflow Chronicles TV. It's in the description. And we'll hopefully see you guys. This will probably be on replay over there. I have to wait until this fully publishes and goes through though. But you guys rock. See you guys tomorrow.
Take care. Have a good one.